You know, I was thinking of David Stockman when we had Andrew Yang on, the Democratic presidential candidate, among many, because the former Reagan budget director, David Stockman, really doesn't distinguish much between the parties these days. They're both inclined to spend a lot more than what we have, and that trend is not good. David, good to have you.
Happy to be here.
So there was nothing that Andrew Yang was raising that enticed you outside of just more spending, just on different causes.
Yeah, I mean, we need to wake up and smell the roses here. We're in year 10 of the longest business expansion in history. We're increasing the deficit at the very wrong time. They say it's $900 billion this year. It'll be $1.2 trillion of borrowing at the same time that the Fed is beginning to shrink its balance sheet, which means they're dumping bonds into the market.
They're holding off on that, but it doesn't matter.
They're not holding off on shrinking the balance sheet. They're holding off on the rate increases. But my point is, it's finally catching up with us. We've gotten by with this for 30 years because the Fed has been monetizing the debt, buying bonds hand over fist. When Greenspan arrived, the balance sheet of the Fed was $200 billion. At the peak, it was $4.5 trillion.
Now it's around $4 trillion.
Yeah, but $4.3 trillion of debt was bought up by the Fed. That drove prices up, yields down.
So it made everything that was going on.
It made it seem that you could there was a free fiscal lunch. You could get by with all of this.
But that's what voters want, right?
Well,
I mean, they're hearing Medicare
now
for all. They're hearing, checks for all. What do you think?
I agree, but now they're going to have to live with it because interest rates are going to normalize. And it's not the $22 trillion debt we have now. It's that there's $40 trillion baked into the cake over the next 10 years. In other words, if you take what Trump has done on top of the bad deficit he already inherited, you're going to be in multi-trillion-dollar deficits year after year, and we're going to have a recession. And this is the key point I want to make today. Trump was elected and sworn in month 90 of the third longest business expansion in history. It's a 48-month term. That means month 138 will be the end of his term. We've never, ever been there before in American history. Never been an expansion that long. The longest one is 119 months. That was in the 1990s. Much better time. We had tailwinds everywhere. Surpluses for 2 or 3 years. The Fed's balance sheet was $500 billion, not $4 trillion. China was just getting up on its hind legs and booming. Europe just went to the single currency. They were going to borrow and spend like no tomorrow. All those headwinds in the year 2000. Now,
there are many who look at that and say we can afford to go a little longer with this because the growth, certainly in the early years after the meltdown, was so tepid. This could push out further. You just
I really doubt that. When you look at how much debt we have on the economy, you look at all the headwinds coming around the world, you look at finally delayed normalization by the Fed. They've dithered, they've delayed, they've ducked and dodged. Finally, they're trying to ooch up the interest rates. So interest rates after 30 years are going to be going up, not down, because look,
what if they don't go up at all this year?
Well, they will next year, the year after.
So it's just a matter of time.
It's a matter of time. And here's the reason why. For 10 years, we've had a federal funds rate, which is what the Fed controls. You know, it's price control. Overnight, which drives overnight money, below the CPI rate almost all of the time.
Consumer price index.
Okay, so that's the same. Yeah, that's the same thing. You're saying zero cost money.
I understand, but let me get your take on this. When you were with Ronald Reagan and the famous woodshed moment where you just sort of spelled all of this out, what was going on, early on he was surprised after his tax cuts the deficits were getting worse. Now, you pointed out because they were spending like crazy and then whatever money was coming in, they spent. But he was troubled by it. And then he got to a stage where he wasn't so troubled by it because other advisors were saying, yeah, but look at the boom, look at the 20 million new jobs, look at all of this. Don't worry about deficits. They don't matter. You say now, decades later, they matter.
They matter because finally the Fed is stopped monetizing the debt. The fact is, in 1987, it was about ready to explode in the face of the Reagan administration. Interest rates went up from 7% to 11%. I'm talking about the Treasury bond right now. We had the Black Monday stock market crash, which was generated by the fact the deficit was so big. And before that point, it was an honest bond market. In other words, the Fed wasn't buying in all the bonds. And interest rates were rising. Private investment was being squeezed out. The economy was overheating. We're about ready to have a big recession. Greenspan panicked when the market dropped 20%, opened up the spigots, and entered a 30-year period of massive and maniacal, I would say, bond buying by the Fed.
So that might have put out fires, but it simply made other disasters.
Well, I would say it made a worse fire because it deferred the day of reckoning, clearly.
When is that day of reckoning? I'd like to know.
I think we're here. Okay,
really?
I think we're here because the Fed stopped buying bonds
what would
2
you
years
invest
ago.
In?
I think you get out of the market, the bond market, the stock market. Put your money in cash, put your money in treasury bills. Wait for the the collapse to come, because it's going to happen, and then there'll be plenty
of.
You've
been saying this for quite a while.
Well, that's true. Well, they were saying that in the year 2000. This time is different. The market dropped 80% on the Nasdaq 100, 50% on the S&P. They said that was a fluke. We got to 207. Same thing happened.
By the 2020 election, because if that's the case,
I think there's no way this economy, given all the headwinds in the world, all the debt, the Fed tightening, everything else that's going on, the trade wars, the uncertainty, the unpredictability of the unhinged fellow who's in the Oval Office, put all that together, and are you going to make a 138-month longest expansion in history? I don't think so. And there the danger lies, because if we have a recession and the stock market collapses, which I think it will, the Democrats have 30 choices, and they could add Mickey Mouse to it and still elect Mickey Mouse number 31.
And each one of those choices are big on spending.
Well, that's what I'm saying. Every one of those
doesn't matter.
But here's the danger. They will be elected. There will be a recession. The deficit will now be at $2 trillion. They will be desperate for some way to pay for their programs, deal with this massive deficit. They're going to put taxes on the upper income and the wealthy like you've never seen before. It will be all over except the shouting. Elizabeth Warren, all the rest of them, wealth taxes, 70% marginal rates. That's what's going to happen because we've allowed the Fed to create such a massive imbalance in wealth. This isn't free market stuff.
Right. Okay.
Let me give one figure. In 1987, when Greenspan started this, the bottom 1%, or the top 1%, had 34% of the wealth. The bottom 90 had 34% of the wealth. I don't argue about that. That's the free market. You get equality of opportunity, not outcome. Here we are, 30 years later, the top 1% has 40%, and the bottom 90% is all the way down to 20%. 2 to 1. That's not natural, and people are going to be angry about that. And when the Democrats get done, we're going to be back where we were when Ronald Reagan was trying to deal with the legacy of World War II taxes. It's a bad situation coming, and all these people down in the stock market who think, everything's going to be roses and unicorns. Unicorns.
All right. David, this is why they have your picture outside the exchange. Do not let this guy get in. David Stockman, the former Reagan budget director. I look forward to your new book when it's out very soon.